Alrighty, folks, if you watch my daily financial news, you know that we have got above 7% interest rates. We saw some violent moves Monday, Tuesday with the 10-year note. We are now pretty solidly over 7%. It has been my long held belief that 7% will slow the housing market down. Below 7% will speed it up. However, that's just my opinion. Let's talk about what Realtor.com has to say about new listings, active listings, hot off the press, never seen before, with the one and only Lance Lambert. What do you got?
Housing. I just got the numbers 5 minutes ago. So let's take a look at them together. I haven't even digested them myself yet. So these are active listings from Realtor.com, condos, single family homes in the US for sale. And so March went up. It went from 664K to 694K. So about a,
4% ish.
thousand no, like 30,000
Yep, 30,000.
units homes. And normally for March, you are usually still kind of like in that falling, or slightly rising. You can see in 2017 and 2018 and 2019, it was actually a very slight uptick.
Right.
So it's not super abnormal to see an uptick, but that is bigger than normal. And it is very different from the past couple years during the pandemic, where 2021, 2022, and even 2023, it was still falling. Now, two of those were obviously super overheating years,
Right.
which is they were falling. But we are starting to see now a trajectory to where, if you put in normal seasonality, you're going to get back as close as we have been to
Right.
pre-pandemic this year, as long as
Yeah.
rates kind of stay in this
Can you
where
do
we
me a
are now.
can you do me a
Um,
favor? I want to look at something. Can you 2017, which is the
yep.
dark green line at the top. Can you show me the March number in 2017?
Yeah, so there
Okay,
was one
1-1.
was 1.2 million units.
And then go to
Um,
the peak. Is that July probably for the dark green?
all dark green. The highest in here is August 2017, 1.3.
All right. So the reason I'm going to look at that is at least the early trajectory of 2024 most mirrors, and that's pretty hard to do with 3 months. But even in 2017, the inventory went up about 100,000 from March to August in this case, which is about a little bit less than 10%. So I'm just trying to figure out if we did the same thing March of 24 to August of 24, we would go from what was it, 600,000 or 560? What was it in March of 24?
Um,
So
694. Actually, let's just go and do the math together. Give
okay.
the audience a little more here. So actives, and you want to go from March to August. So let's
Yes.
do it this way. Let's do August to March for 2017.
Okay.
That's 13%.
Okay.
And 2019, 10, 20. So let's just say 15%, just
All
to
right. Yeah. Blended average. Okay. I like it.
um that would be 794 or seven.
799. Yeah. So
um
800,000.
yes, which would put us um about where we were in 2020. So 2020, we were already starting to overheat. So as we were kind of in that free fall for inventory, it
Mm-hmm.
takes us back to the August spot. And of course, actives, from 2020 and even through 2021, even though there was seasonality and some upswings, it was
Mm-hmm.
really on a downward spiral until about March 2022, which is really the peak of the pandemic housing boom, like the
Yeah.
end of it.
So
Uh,
August 800,000, again, just using past as an indication. That still keeps us what, 75% of 2019 August?
yeah, yeah, you got the right number to use. So let's do that. So August divided by um
Yeah.
2019. And this has been the one where if it's
Oh,
still 35,
35%.
yeah, so
Wow.
more than I would have thought. So even if like, let's say we have a really big inventory jump, like let's just say um, let's say it's
Say it's
25%.
yeah, say it's 25. What the heck?
And then you take that, you would still end up
Wow.
somewhere between we're in, yeah. So I would say that's probably the case is come August this fall, we're still going to be down somewhere between 35% and let's say 25%, even if it's a bigger inventory jump. So you're
No,
still going
I want to
to,
poke at that a little bit because this is important because I think you are right. If, and this is a big if, mortgage rates stay at or above 7%. I don't, as I sit here today in early April, I don't, that is certainly possible and frankly something I'm hoping for, but I don't know that it does. I'm willing to guess, Lance, if we saw rates closer to 6.5% in August, these numbers, we have no chance of 800,000. I think there's so much marginal demand waiting, thirsting for 6.5, but maybe I'm wrong.
yeah, I think a lot of it's these rates. And it's also, the fact that these new listings are rising is some of these would-be sellers slash buyers, and they're not just sellers, they're also buyers
They're also buyers, correct?
into the market because they're like, you know what? We're not going back to 4% mortgage rates. I've had another
Mm-hmm.
kid. It's time to move on. So some of this uptick in actives is just because the new listings are also pushing up as we start to kind of bounce off the peak of the lock-in effect.
I
And
agree.
so here's the new listings. There is still absolutely a lock-in effect. And I would say anything between here and let's say these bars, I call the
Mhm.
lock-in effect. But this jump over 2022 I call easing lock-in effect.
I think
Uh,
that makes sense. I think that
and
makes
so
sense.
you're probably going to see it go like this. Usually new listings for realtor.com for the US rise every single month from December to June or May, pretty much. And so we'll probably see this black bar kind of rise up to here and then start to roll
Roll
over.
over.
Yeah. So
Yeah.
as that seasonal rollover happens and new listings are no longer increasing, and that'll be the question of where does actives move then? If it keeps rising at that point, then it's like,
Mhm.
okay, this market's still softening as we kind of hold at these higher rates.
Yeah. And again, I really do think this sometimes economics and housing is really simple. I think it's all rates. I really do believe 7% is seen as bad and sub seven is good. And what I mean by that is consumers over 30 years of studying them have proven to me be extremely consistent. All consumers want a deal.
Mhm.
That's the magic of consumers. When they're buying something, they want to feel like they're getting a deal. And for the last 12 months or so, certainly for the last 2 years or so, with the rates ripping higher, they were anchored on lower rates. They were anchored on 3 and then 4 and then 5. What we have seen now is we are seeing some buyers anchored on 8, right? That's the most recent memory. So when it goes sub 7, it's good. I think the longer rates stay at 7, the better chance we have of un unbreaking or unpacking the housing market. But as soon as rates break to 6.5, and I do think that's the magic number, home buyers are going to feel like they're getting a deal. And I bring that up because of this chart. I think if you believe what the Fed is saying, what Powell is saying, and you know all these other Fed presidents, rate cuts are coming in Q4. According to that previous chart, listings are falling off quickly in Q4. New listings.
Yeah.
So if inventory or new listings are falling in an environment where rates are rising or rates are lowering, that could be a very interesting combination.
Yeah, and big picture, rising actives nationally is a good thing. We were in
Mm-hmm.
a healthy housing market,
Agreed.
and if you have 7% mortgage rates and you don't get any healing on the active side, that's a bad thing. And
That
so
is a bad thing. Yes.
going through this window like we are right now is allowing us to take that appreciation from the pandemic housing boom and kind of smooth it over a
Yeah.
few.
Spread it out. Add duration. We're
Yeah,
adding
it's not
duration.
necessarily that nominal prices are falling, but if actives can move up and you slow down and even see some declines on real adjusted home prices, so
Mhm.
inflation a little higher than home prices, that allows you to smooth it out. And then, there has been a lot of calls this whole cycle of, hey, lower rates, lower rates, lower rates. A paper came out from the Dallas Fed this week that said, hey guys, even if the Fed didn't raise interest rates, housing affordability would have deteriorated, not as much as it did, but it would have still deteriorated more because guess what? Home prices would have went up more than they did.
Exactly. Yeah.
And so the Fed has kind of stopped some of that gains. And why that matters is there's a lot of wealth in the country in residential housing. And there's a
Oh,
lot of people who would love to tap into that wealth, but they're
correct.
not going to do it at 7% mortgage rates. They're not going to do a
Correct.
lot a refi,
Mhm.
cash out refi at 7%.
Mm-mm.
5% they might.
It's yeah. What I think they call tappable equity
Yeah.
is at record highs. We actually see record highs in net worth. Again, what I talk about here is it's you can't argue the fact that owning assets long term is how you build wealth in this country. It's just how it works. And yeah, home equity is the largest bucket for the average person.
So
So
let's play that out a little bit. Let's say the Fed had not raised interest rates as much.
sure,
Prices would have went up more
sure.
and that equity would have been tapped into. So not only would
Oh,
there be
absolutely. Yes.
and so that gets to a part of the counterfactual argument on the rate side, which is some people say, oh, inflation is decelerating, came down, and that had nothing to do with the Fed. That was just kind of coming out of the pandemic and all of that stuff. But I think it's important for those folks to remember that, hey guys, had the Fed not done everything that it was because housing was overheating like
Yeah.
it was, there's so much wealth in housing that itself could have fueled more inflation and we likely would have been in a place where price growth in the overall
Yeah.
economy would be higher right now had the
Oh,
Fed.
it would be a disaster. I mean I remember probably one of the most memorable conversations I had with a real estate agent with Beth Traverso. I think it was March of 22. It was at the lows of inventory for the entire market of King County, which for the average person we could say Seattle. For the entire month, the average purchase price to list price, Lance, was 112%. I
Wow.
have never seen anything close to that. That's the entire month for the entire county. The average was 112% purchase price to list price.
We're
That is
talking
not
like
normal.
February, March 2022.
22, March of 22.
Okay. Yeah.
So the reason this is important is that if that continued for, say, 6 months and rates stayed where they were, we would have seen national home prices go up another 10 or 12% in very quick order. To
Yeah.
your point, owners would have cash out refi, they would have double up, they would have bought more, and the economy just would have ripped and inflation would have been higher for longer. So rates matter.
Yes. Yeah. Yeah. And I mean, I know somebody who was rushing to remodel their house at the end of 2021 into 2022 so that they could do a cash out refi and buy a boat. And they ended up getting 4.5%. Had they
Yeah.
finished that remodel a few months earlier, they would have been a much lower rate. But
Yeah.
had they taken another 2 or 3 months to do it, they probably just couldn't have done it because rates were
Yeah. They
literally
jumped to six. Yep.
April, May, June. Yeah, it was like going right before that.
Yeah. Yeah. At the end of the day, rates matter. Again, I am one that sits here that hopes rates stay at 7%. I know it doesn't feel good in the moment, but it allows us to have time. Um, see if I can
And
find his name.
there
There
is
was
one
an
more thing I should point out is
go
that
for it.
not all of this inventory jump is even. Florida, and and I just talked
Oh
to some
yeah.
people out in
Yeah.
Southwest Florida who, and I don't want to scare people, but they actually told me straight up that they think that they're kind of worried now that the buy downs for their market could have, uh, you know, created a bubble on the home building side because the prices should
Sure.
have came more than they should have already.
Yeah.
But in Southwest Florida in particular, which was like that area that was hit by the hurricane
Hmm.
in
It's ugly.
September 2022, and then what that hurricane did is that it not only helped to increase, and well, it was really coinciding with the home insurance shock that was already coming for Florida.
Hmm. Yep.
It accelerated it. And then the other thing that it did is it changed the pandemic migration to Southwest Florida. There was a lot of people coming there
Hmm.
that pulled back. John Burns has a great chart on that showing them going from huge net in migration to net out migration.
Mm.
And the other thing is that when you have damaged properties that go onto the market, that's more supply, right? And so
Yeah.
market saw a bit more of the affordability squeeze because they not only saw the price growth that everybody else did, they actually saw a little more too of that. They saw the rate hikes that everybody else did in Southwest Florida. But then they also got the other affordability shock, which is the home insurance.
Correct.
And on top of it, you've the shifting migration, which is really that's the lever that helped to move Austin down, which is
Hmm.
you had all the California money coming in, then
Yep.
very moving out. And then, of course, the other factor being they had some more supply because of the damaged properties. Now, if you want to put a fourth bit to it, unlike some of the other markets, Southwest Florida does have new construction in pockets of it. And so anytime you have new construction and you have a big pullback in demand, that can create an extra lever down.
Yeah. The last thing I'll say about that market, really any real estate market that has a natural disaster that comes through, some of those properties ultimately are going to end up in foreclosures and short sales because maybe the homeowner didn't have insurance or they took the check or whatever. And what people need to realize is there's a delay in the inventory showing up, right? The hurricane was years ago, but we are now just seeing that damaged inventory come to market, and it's had 2 years to get more damaged, and thus, a lot of price points are going to be lowered because it's just damaged inventory.
And if anybody wants to find those homes, you go to realtor.com and you can filter damaged or damages, and the homes will pop up. Now,
Absolutely.
one thing that I noticed is that about half the homes that pop up say this home was not damaged by Hurricane Ian.
Yeah, not damaged. Yeah.
So that actually threw a little bit of a wild card to me when I was going through looking at the listings because I was like, oh, that number is actually a little more inflated than it actually is.
Yeah.
But the fact that so many people are listing it on their listings as not damaged tells
Mhm.
you that there's a huge impact on the
Oh,
market.
absolutely. That definitely, when you have a listing that actually says we're not damaged. I remember in 2010, homeowners would say not a foreclosure, not a short sale, because it was just so dominating the market. The last thing to talk about,
Can I
Dr.
say one last
Paul.
point? One
Yeah.
last point, which is it didn't get a ton. I feel like Hurricane Ian didn't get a ton of coverage at the time, but it
Mm.
actually is the third costliest hurricane ever in US history.
Oh, wow. I did not know that.
And just because there's so much real estate in Southwest Florida,
Sure.
high priced real estate.
That makes sense. That makes sense. It was very interesting. I read a white paper by an economist, Dr. Paul Willen, senior economist, Fed Reserve Bank of Boston, out talking about the lock-in effect. And basically, to net out a very dry paper, the only answer is time.
So
And
you found something before I did. Wow. I have not seen this paper yet. I
yeah,
haven't even heard of it.
yeah.
And who is
Dr.
it?
Paul Willen, Wilen, senior economist, Federal Reserve Bank of Boston, talking about what fixes the interest rate lock-in. And
Yeah.
the
Where
only
did you
answer
get
is
this?
time.
How did I miss this?
I don't know.
Is it an older paper?
No, it just came. I think it was last week it came out. I think I'll find
Okay.
it and send it to you.
Interesting. Yeah, I found a little bit on it. Interesting.
Yeah.
Or wait, no, I think I didn't. I don't know. I found the guy though.
Yeah, that's
Um,
it.
he says time.
Yeah, time is the answer. And you and I talked about it. The 54-year spreadsheet, man. People need to stop sleeping on that free spreadsheet because that's what told us that spreadsheet told us that time is the only answer to fix it.
You
Well, there
know,
you
I
go.
do have
Find this
one
article.
more thing. I do have one more thing that I want to pull up. And, this could also be cut into another video, which
Sure.
is, and I didn't realize my screen was still up, uh,
It's okay.
is that I have a story coming out today looking at, and if you want to add to these, go for it. But I'm
Mm.
looking at what are the 6 reasons that home prices are stickier than other assets. So maybe I go through them and you
Okay,
say if you agree with it or you disagree with it.
done. Let's do it.
Okay. So, and let me pull up a chart for this. Okay. So, and this is a chart I'm still working on, so it's a little sloppy.
Okay,
But this is the year-over-year change for the S&P 500 and the year-over-year change for the Freddie Mac House Price Index.
makes
So
perfect
stock
sense. Okay,
aggregation of 500 stocks, aggregation of residential real estate, home prices,
I
single
like
family.
it. Hmm.
What you'll see is that stocks are all over the place. Go up all the time and then have the big drops. And, it's not uncommon for, 10%, 20% drop offs. And actually, if you didn't do year over year and you did these month over month, the
Yeah, it's even worse.
volatility is even worse
Yeah,
because you have periods like March 2022 or 2020 where I think briefly what we were down like 30%,
yeah,
25.
30. I think 34% for a minute in that
Yeah,
month.
but on a year over year basis, we were never down more than five because
Yeah, just
it recovered so quickly.
yeah.
But then you look at home prices and it's just not like that. And Case Shiller did briefly go negative this cycle. Freddie
Hmm.
Mac actually didn't. It was like FHA
Hmm.
that did. And then, in the 90s, while there were some markets that were down, Freddie Mac didn't really go down. There was the 82, which Freddie Mac
Hmm.
saw more of than like Case Shiller,
Hmm.
but not a lot of drops other than, that
Yeah.
08, 07 to 12 one.
Yep.
And so doing a story for this week, looking at what are the 6 reasons that home prices are stickier than other asset classes. So I'm going to go through them and you let me know which ones you think are
Okay.
true and you agree with, or which ones you disagree with.
Okay.
Okay. First one I have is emotional attachment. Homeowners often have emotional ties to their homes, making them reluctant to sell at lower prices even when demand pulls back. Sellers may have unrealistic expectations about the value of their homes based on past trends or sentimental attachment, resisting price reductions. What do you say to that one?
Oh, it's absolutely true. We're seeing it today. I just had a conversation with an agent who is trying to help somebody sell something in Palm Springs. Palm Springs, as you know, has been hit hard by the Airbnb bust and changing rules. And she is anchored on a price that somebody got a year ago, and she's not going to sell for a penny less. So the answer is that listing is going to expire and she's not going to sell. So yes, homeowners anchor or AKA are emotional on other factors. Yes.
Okay, number two, supply demand imbalances. If a housing market is undersupplied, it usually stays undersupplied for years, putting upward pressure on prices. Regula Regulations governing the real estate market, such as zoning laws and building codes, can also restrict supply and contribute to price stickiness.
Equally, so supply 100%, demand the same way. I mean, the pandemic kind of threw a wrinkle in that by work from home and you could do all these things. So we're seeing some of that be tested on the demand side. But yeah, in housing, we talk decades. In stocks, we talk quarters.
Number three, illiquidity. Selling a house differs from selling stocks. It entails a lengthy process of negotiation, legal formalities, and associated transaction costs, all of which contribute to the sluggishness of price adjustments.
Yeah, one of the things, the reason I'm not a great stock investor is I'm an emotional person. I read a headline, I do this or that. I could sell with a click of a button. That doesn't happen in housing. So, um, yeah, the fact that real estate is harder to sell, yes, emotional decisions are avoided.
Okay, so this one I call as the Zuber one, which is
Uh-oh.
inflation. The Federal Reserve has a mandate from Congress to promote maximum employment and stable prices. The Fed has set a goal of 2% annual inflation. The fact that inflation is constantly occurring in the economy puts long-term upward pressure on nominal house prices.
Inflation's a feature, not a bug. It's a feature, not a bug. Yep.
Number five, leverage. Long-term fixed rates, particularly those subsidized by the U.S. government, can contribute to the stickiness of house prices. These mortgage products enable buyers to spread the cost of home ownership over a longer period making
Mhm.
it easier for them to afford homes even when prices are high.
Yep.
Pretty much fixed rates.
Yeah. Fixed rate, 30-year debt. People buy on payment, not price. I wish more people understood that. It's all about the payment. And 30-year fixed rate debt is magical. It's a one-way bet. You can refi if they go lower. You don't refi if it goes higher.
Okay, last one, necessity. While there's a bit of a luxury element to some housing, think second homes, Airbnbs, shelter is a core human necessity that puts a floor on how far demand can pull back.
Agreed. Agreed.
Awesome. Okay, so we're
Yeah.
pretty
So
now.
there's one that I thought of right off the top of my head. Now it's kind of covered in a couple of those six, but and you're going to have the words that I don't. Basically, stocks are a financial assets.
Hmm.
A home is not, right? Even in the chart, we're comparing supposedly two asset classes, but for most people, the home, it's not a financial asset.
Yeah.
That's 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 the big thing to me. So if it's not the financial asset, then it's emotional to one of your points. It's a necessity. It's one of the Maslow hierarchy of needs, right? You got to live somewhere. But I really do think there's a lot of folks that look at their home as not an asset.
Yeah. Yeah, that makes a lot of sense. And yeah, and then a lot of people are like, so what if it goes down? Which is a bit different than other
They
assets.
won't. Yeah, they won't.
And
Like
they're
there
like,
are people that don't.
I'm not selling anyway.
Doesn't matter. I'm going to live here until I'm dead. Right.
Yeah. Yeah, that's a good one. I'll try to weave that into the last one for
Yeah, it could be
the
there.
uh,
Very
or
cool. Well,
necessity.
thank you for giving us a sneak peek. Thank you for giving us data hot off the press. March active in March new listings. It's going to be fun to watch. Rates matter. Where can people follow you?
Yeah, they can Google Resi Club Analytics and sign up for my newsletter. The other thing I'd recommend is Google zuberletter.com and sign up for your newsletter, which I'm going to be helping out a little bit with and adding a couple that.
He's being modest. It is only being created because he is willing to work with me to take my crazy ideas from video and put it in words, which I could not do. So the Zuber letter is something I always wanted to do, but never thought would be born until I met this young man. So Resi Club in one rental at a time, zuberletter.com, zuberletter.com, zuberletter.com. Lance, you're amazing, man. Thanks.
Thank you. Bye.
Got it. Bye.